Your money-making broadcast starts now. This evening on Bay Street, Canadian markets showed surprising resilience as a brutal sell-off in U.S. semiconductor stocks dragged the Nasdaq lower while energy stocks surged here at home. The TSX Composite ended the session higher by 0.44%, buoyed by strength in Canadian oil and gas producers. The story of the day was not a chip rally but a chip wreck. Qualcomm crashed more than 11.5%. Intel plunged nearly 7%. AMD and Micron also fell sharply. Meanwhile, in a direct and meaningful win for Canadian producers, the United States announced lower steel and aluminum tariff rates for Canadian and Mexican exporters. Oil prices climbed after the White House rejected an Iranian peace proposal, sending Canadian energy stocks sharply higher. It was a day of starkly different narratives playing out on both sides of the border, and each one has implications for Canadian investors. Let us start with the story that dominated trading today, and it is not what the headlines would have you believe. This was not a semiconductor mega rally. It was a semiconductor sell-off. Qualcomm was the hardest hit, crashing 11.46% to close at $210.31. The drop erased nearly all of Thursday's 8.4% gain and came after reports of increased competition in the mobile chip market and concerns about demand in China. Intel fell 6.82% to $120.61, continuing its long-running turnaround saga with no clear catalyst in sight. Advanced Micro Devices declined 2.29% to $448.29, reversing some of its recent gains. Micron Technology fell 3.61% to $766.58, weighed down by broader weakness in memory chip names. Even Cisco Systems, which managed a modest gain of 0.58% to $99.29, could not escape the broader sector rotation out of technology. The breadth of the selling was notable, with semiconductor stocks seeing some of the heaviest outflows of the year. For Canadian investors holding U.S. equities or ETFs with semiconductor exposure, today was a day of portfolio adjustment. But here at home, the Canadian energy sector told a completely different story. Crude oil prices moved higher after the Trump administration formally rejected a peace proposal from Iran, escalating geopolitical tensions in the Middle East. Suncor Energy gained 2.21% to $66.56. Canadian natural resources surged 3.83% to $46.92, making it one of the best performers on the TSX. Enbridge rose 0.70% to $54.84. The oil price move has direct implications for the Canadian dollar, which strengthened against the greenback as petrocurrency flows increased. For income-focused Canadian investors, this energy strength provides a meaningful tailwind for the TSX, which has a roughly 17% weighting in energy stocks. The move also underscores the ongoing importance of geopolitical risk in oil markets, a factor that could persist as long as Middle East tensions remain elevated. Canadian producers are among the largest beneficiaries of sustained higher oil prices, given the country's position as a major exporter. In a major trade development, the United States offered lower steel and aluminum tariff rates for Canadian and Mexican producers. The announcement came as welcome news for Canadian industry, recognizing the integrated nature of North American supply chains that have developed over decades. For Canadian steel producers in Ontario and aluminum smelters in Quebec, this reduces a significant burden that has weighed on the sector since tariffs were first imposed. The move also signals a broader willingness from the current U.S. administration to engage in trade diplomacy with Canada, which could pave the way for further agreements on softwood lumber, dairy, and digital services. This is a net positive for Canadian equities and provides a constructive backdrop for cross-border business investment. The macro picture was more complicated. Bank of America issued a blunt warning on Federal Reserve rate cuts, arguing that markets are pricing in more easing than the economy needs given sticky inflation and a resilient labor market. For Canadian investors, this message carries extra weight because the Bank of Canada has limited room to cut rates if the Federal Reserve holds steady. Higher U.S. rates also mean higher borrowing costs for Canadian companies with U.S. dollar-denominated debt. The Bank of Canada's own policy path remains uncertain, with some economists expecting a cut as early as June, while others argue the central bank must wait for clearer signs of economic weakness. The divergence between U.S. and Canadian rate expectations has also put pressure on the Canadian dollar, though today's energy-led rebound provided some relief. In corporate news, Alphabet and Amazon tapped overseas debt markets this week, raising capital for artificial intelligence infrastructure spending through Eurobonds rather than higher-cost U.S. markets. This signals that the AI build-out is accelerating, which benefits data center suppliers, networking companies, and power infrastructure providers. For Canadian investors, this is a reminder that the AI theme extends well beyond the big U.S. tech names and into Canadian companies that supply the physical infrastructure needed for data centers, including power generation and transmission companies. SoftBank announced a $100 billion investment in France for AI and technology infrastructure, further underscoring the global scale of AI capital spending. Costco crossed $1,000 for the first time earlier this week, and continued to hold above that level, closing at $1,021.88, up 2.24%. The milestone reflects the retailer's consistent execution and loyal membership base. Apollo Global Management acquired Emerald Holding and QuestX Media for $1.5 billion, consolidating the business events sector. On the Toronto Stock Exchange, Shopify fell 2.63% to $99.84. The Canadian e-commerce giant was caught in a broader technology pullback that affected growth stocks across the board. For a stock that has had significant volatility, the move lower reflects ongoing uncertainty about consumer spending and the pace of e-commerce adoption normalization after the pandemic surge. Shopify weighed notably on the TSX, but the strength in energy names offset that drag, allowing the index to close in positive territory. Roku declined 0.34% to $127.63, a relatively mild move compared to the broader tech sell-off. Pfizer rose 0.23% to $25.87, while Oracle fell 3.62% to $186.83, continuing a multi-week decline. Now it is time for our stock picks, drawn from the wisdom of four legendary investors. Our first pick is Shopify from Peter Lynch, the legendary fidelity manager whose hallmark advice is to buy what you know. Shopify at $99.84 is a classic Lynch pick because it is a company that most Canadians know and understand. It powers online commerce for millions of merchants worldwide, from small boutique shops to large enterprise retailers. Lynch favored companies with simple business models, strong competitive moats, and the ability to grow earnings consistently over time. Shopify fits that profile. Its ecosystem creates switching costs for merchants who build their businesses on the platform. Its revenue trajectory, driven by gross merchandise volume growth and expanding services, makes it a growth story that patient investors can buy on weakness. For Canadians looking for domestic technology exposure, Shopify is the premier name on the TSX. Our second pick is Enbridge from John Templeton, the pioneer of global value investing who famously advised buying during pessimism and selling during optimism. Enbridge at $54.84 is a textbook Templeton pick. The stock has been out of favor as the energy transition narrative has dominated headlines, with many investors questioning the long-term viability of fossil fuel infrastructure. Templeton would see this as exactly the kind of contrarian opportunity he favored. Enbridge generates steady cash flow from take-or-pay contracts that insulate it from commodity price volatility. The company has a long track record of growing its dividend annually, currently yielding well above 3%. It operates essential infrastructure that will be needed for decades, including for transporting lower-carbon energy sources like natural gas and hydrogen. Trading at a reasonable valuation with built-in inflation protection through rate-regulated assets, Enbridge offers the margin of safety and contrarian appeal that Templeton prized. Our third pick is Cisco Systems from Ben Graham, the father of value investing. At $99.29, Cisco trades at roughly 15 times earnings with a dividend yield above 2.5%. Graham would be drawn to the margin of safety here. Cisco supplies the routers and switches that power the global internet, and the artificial intelligence data center build-out is driving demand for higher-speed networking infrastructure. The company has a fortress balance sheet with tens of billions in cash and investments, generates substantial free cash flow, and has been returning capital to shareholders through dividends and buybacks. Graham looked for companies with durable competitive advantages trading below their intrinsic value, and Cisco fits that framework. While Cisco is not an exciting story stock, it is the kind of steady, well-capitalized business that Graham saw as the foundation of a sound investment portfolio. Our fourth pick is Roku from Cathie Wood, the ARK Invest founder who focuses on disruptive innovation. Roku at $127.63 is the leading streaming platform in North America, and would argue that the shift from linear television to streaming is still in its early innings with massive room for growth. Roku monetizes through its platform, taking a cut of advertising revenue and subscription fees. The company has tens of millions of active accounts and continues to grow its user base, though the pace of account growth has moderated. Would emphasize that disruptive companies often require patience, and that the addressable market for connected television advertising is enormous. As traditional television advertising dollars continue to migrate to streaming platforms, Roku is well positioned to capture a significant share. The stock requires conviction and a long-time horizon, but for investors who believe in the streaming revolution, Roku remains one of the purest plays. Together, these four picks form a diversified portfolio that covers different investing styles and sectors. Shopify gives Canadian technology and e-commerce growth. Enbridge gives energy infrastructure and income. Cisco gives value and networking exposure with a strong dividend. Roku gives disruptive streaming innovation. Whether you lean toward growth, value, income, or innovation, there is something here to consider. The key is to match each pick to your own investment philosophy and time horizon. Each approach is valid, but they require conviction and discipline. Looking ahead, watch for U.S. inflation data and further trade policy developments this week. The Canadian dollar's reaction to oil prices will be important for anyone with U.S. dollar exposure. For Canadian investors, the combination of a strong energy sector and improving trade relations creates a constructive backdrop. The equal-weighted S&P 500 held up reasonably well today, suggesting the selling was concentrated in large-cap technology names rather than the broader market. Small caps showed relative strength, and energy stocks provided a lift across exchanges. This is the kind of market environment where stock picking matters more than index hugging, and our 4 picks reflect that philosophy. Remember that investing is a marathon, not a sprint. Days like today can feel alarming, but the best investors tune out the noise, focus on strong businesses, reasonable valuations, and maintain patience over the long term. The semis will recover, energy will cycle, and disciplined investors who stick to their process will be rewarded. That is your market close for May 12th. Semiconductor stocks sold off sharply on Wall Street, with Qualcomm and Intel leading the decline. Canadian energy surged on oil price gains tied to tensions with Iran. Canadian producers got a significant trade win with lower U.S. steel and aluminum tariffs. And the TSX held up well thanks to energy sector strength. Our stock picks today draw from 4 different investment philosophies, each offering a distinct path to long-term returns. As always, do your own research and invest with a time horizon that matches your goals. I'm Chloe. See you at 7 a.m. Eastern for shorts. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.